Good evening, folks. Just a quick little video review of today's price action. I will not be trading tomorrow. I won't be doing much at all, really, with the markets and having a 3-day weekend, if you will. If you watched the analysis video I did last night, and if you were part of the Twitter engagement that I do every day, pretty much on Twitter, I'll give you my commentary. I'll point to where the next draw on the liquidity is. It means where I think the market's going to go reaching to next. If there's a fair value gap or an order block, something that's noteworthy at the time, I will call out the very specific candle time. And that way you can annotate your charts live and watch price action real time with us. Last night, I gave you the analysis for the E-mini S&P. Before I go into it, if you take a look at what has been going on in Forex, okay, with dollar index, it says sloppy, choppy, and euro dollar and pound dollar, while overall it's moving higher like I've given you earlier in the year and lower on the dollar index, I don't want to be trading those markets because look at the difference between that and what you're going to see here tonight with stock index futures. And I understand that some of you simply want me to talk about Forex because that's what you are trading right now. I'm not trading it. So when the markets loosen up a little bit, hopefully, and there's a little bit more movement and they're more fluid in their delivery and price, I promise you I will be more active in talking about it. But for the moment, my time and attention is focused on stock index futures because that's where the cleanest price action, the surest delivery and symmetry is to be found. Forex is not it right now. I'm not arguing the fact that Forex isn't gyrating a little bit. It's just it's not as clean as you're going to see here today. So I mentioned on last night's review that we would be looking for the consequent encroachment of this candle's wick right here. That price comes in at 4,072 3/4. The dashed line is going to be an old high formed here, and we'll drop down the lower time frame now. So I'm skipping over the hourly chart because I want to get right to the heart of the matter here. The 15-minute time frame is a bellwether chart for me. It means most of everything I'm going to be looking for can be found on this time frame relative to weekly and daily time frame. So if I understand where my draw on liquidity is from higher time frame, daily, and or what my expansion is going to be for weekly, is it more likely to expand higher or more likely to expand lower? I can jump right to the 15-minute time frame and find everything I need to utilize for a trade idea. So if you look at the 15-minute time frame for E-mini S&P, and that's the only thing we're going to be looking at tonight, I'm not looking at NASDAQ. And the reason why is because I'm focusing primarily on ES. I want to show you this year how you can focus just on one market, not have to flip-flop back and forth between NASDAQ and ES, because I get questions all the time from new students or new casual viewers. What is the catalyst that causes me to swing from being a trader in the NASDAQ or the E-mini S&P? And to remove all that concern, because right now there's bigger fish to fry, you need to figure out how to trade and read price. So if you're constantly inundated with the confusion, which is going to be the result of you not having experience, if you just stick to one market, it'll be perfectly fine for you to just not have to worry about one less thing. So just because you see me back and forth, maybe a student of mine or students, moving from one asset class to the next, one market to the next, they're a little bit more seasoned than you probably are. And it's not a knock against your, aptitude as a student or ability to be, a profitable trader. It just means that you just don't have that experience yet, and over time you will. So with that said, I want to take a look at the morning session here. Here's the midnight time frame, and we'll note that opening price here. And you may not see it very clearly, but if you see that purple line here, 40.36 3/4. I'm annotating that as the midnight opening price right here for December 26, 2023. So if we're looking for longs, as I indicated last night, we're looking for higher prices on the stock indices. The ideal scenario is for the algorithm to reprice below that midnight price right here. So you see it do it here after 8:30. So here's 8:30. That's our trigger time. So everything starts at that moment. So 8:30 and then 9:30, we drop down on the 15-minute time frame right before we get to 11:45. So 10:45, that candle, we're dropping down. We're attacking an old low here. We're below the opening price at midnight. So this is allowing smart money traders to get on board with longs to target this high and that 4,072 and 3/4 level that I gave you last night. So last night, hours before the market would even start trading in our New York local time, down here, our focus was up here at that price level. And I started the day tweeting on Twitter with my time frames, keeping this level in view. As a reminder, remember, if you're watching my videos and you're not recording things with your notepad, key levels, things I'm looking for, catalysts that may support or negate a scenario in the marketplace. So it's rare that you're going to hear me say, if it's going to go up, it's going to go to this level here, but if I'm wrong, it's going to go down here and go that. Very rarely will I do that. And I'm admitting before I do something like that at all when I'm indecisive, when I have really no strong convictions one way or the other. I have strong convictions yesterday and last night and today during the market session, and we were looking for that 4,072 and 3/4 level for S&P. The levels that I gave for NASDAQ, notice that it did not deliver there. It delivered like gangbusters here on this market. So I'm not making a case that I picked the right one, so therefore I'm smart. I'm just saying, following one market, I don't care that NASDAQ didn't reach its objectives. I don't care that the euro dollar didn't go where I wanted it to go. I don't care that the dollar index didn't go where I wanted it to go. This is the market I'm trading. This is the market I'm dialed in on. This is the only thing I'm focusing on right now, and it's more than enough. So let's take a closer look. We have a rejection block here. After the market runs up at the 9 o'clock hour, we break down. One more time, it stabs up above the uppermost closing price here. That's a rejection block. It breaks down, and then it runs below the opening price at midnight over here. Now this move here, you might look at that on the lower time frame and say, yeah, that's my model, that's my setup. There's nothing wrong with that. Others that are looking to trade on a longer term time frame, they can't trade ahead of news reports and take advantage of the small intraday fluctuations for scalping or day trading. They have to position themselves on a swing trade. Well, this is how you do it, folks. If we're bullish and we're looking for a move below the opening price to get an ideal power 3 entry, and that's a mouthful. My concept, power 3, is where we're looking for the accumulation, manipulation, and distribution phase of the daily range and or weekly range. But it also can be utilized inside of the sessions, like the morning session and the afternoon session. Each one of those fractals in time, a perspective, if you will, and framing the price in the context of a specific range of time. Power 3 is when I'm bullish, I'm expecting the low to form below a key opening price, and the key opening price for the daily range is midnight New York local time. So we drive down below that into a old low. So sell side below this low is collected, engaged. Why would that be necessary for the market to see that? It's going to drop down below there to absorb all that sell side liquidity and be counterparty to their smart money longs. So they're buying the sell stops here below the opening price at midnight. So that is where you could have a order if you are a swing trader or non-intraday trader. The way you would do that is you would just have your alerts set to tell you when the market dips below that opening price or gets close to it. And if you're bullish, you can put limit orders down there, and then whatever the high you're aiming for, there should be 2 of them. The high of the day that's formed, and then the target you're reaching for, as we outlined last night, the 4,072 and 3/4 level. You don't need to be babysitting it. Your positions will be very small, probably 1 contract, or maybe even a micro, and you just let it go. you don't worry about all these small little fluctuations I'm going to cover now and what I've went through and outlined beforehand live on Twitter. So the market drops down after creating a fair value gap here. It retraces back into it. Consequent encroachment. I called this live. I outlined it, framed it, and said as soon as it hit this level here, as we'll look at on the 1 minute chart, I said this is exactly when it should reject and look for it to go lower and reach for the 4038 level. And that was this sell side liquidity here. The market drops down, digs into the sell side, accumulates, drops back down into the order block here, rallies. We consolidate. This range here is an hourly imbalance. So this little shaded area, if you find your hourly chart, you'll see that there's a fair value gap there. Market rallies, small buy side imbalance, sell side inefficiency, comes down, overshoots that, rallies again, fair value gap, order block, trades down until here, and just real choppy, but still continuously grinds higher, keeps grinding higher. Every time it created a higher high and started to break down, retail traders were expecting this thing to break down. And your focus was where I was telling you last night. Look for that 4,072 3/4 level. There's nothing to fight. You don't want to try to go short against all this because the algorithm is just going to keep on repricing higher and it'll frustrate you. And you can blow your account getting revenge trading, trying to short something like this and not know what it is that you're looking for. And thankfully, you have somebody that's been here for a long time. And I've been around the block a few times, and I'm outlining and showing you and pointing where I believe, with 30 years experience, where the market's likely to go to next. Doesn't mean I'm perfect. Doesn't mean I'm going to be exactly on the money and hitting the mark every week, every day throughout the rest of this year. But I think you'll find that it's pretty consistent, and it's certainly enough for you to try to do well on your own once you adopt this skill set. Dropping down to the 1 minute chart. All right, this shaded little trend line here, okay? That's denoting specific elements of time. So we're looking at a time window where the market starts trading approximately at 9:30 in the morning. And that shaded area right there, that fractal, that amount of price action, that is all you need to worry about if you're trading in the morning session. Just that. If you start looking at your chart like this, framing it out inside that parameter of time, 9:30 to noon, and start looking for inefficiencies, where liquidity pools are, where's there a shift in market structure that's bullish or bearish, something that would jump off the chart, and obviously what I'm going to cover here should be jumping off the chart already. The market trades higher multiple times, higher, and then breaks down. We have a imbalance here, but this has been shown on a higher time frame. But you can refine it. You can use this low and this high here, draw that out in time, and it would completely fill in perfectly like it is here. But from the higher time frame, this is what it would be like, seeing it this way. Then we have the market consolidating in here, breaks below this low here sharply, leaving a fair value gap. Market rallies up, and right on this candle here, I actually mentioned that this candle is what you should be focusing on Twitter. Everything is time and date stamped. I don't delete anything. And when there's a typo, it stays the way it is. The fair value gap here, I outlined and said that we would be looking for this low here for sell side liquidity. And I mentioned I wanted to see it as it stabbed up into it right there. On that very 1 minute candle, as it was a bold-faced run-up green candle, I tweeted and I said I would want to see the fair value gap be rejected right here on that candle. And then on here, I said just like that, another tweet. And you'll see those tweets in a moment. The market does what? It aggressively, quickly runs to the sell side liquidity here. And then I remind everybody that everyone should be square and not in the marketplace. They should not be in there holding on to it. Why? Well, you're learning now. Here's that opening price again. That light shaded purple level at 40.36 3/4. Where are we at below here? Below that opening price in a time when I'm telling you last night it's bullish. So smart money is going to accumulate longs down here. You don't want to hold on to your shorts, expecting it to keep breaking lower. The market rallies, builds a fair value gap here, accumulates, and goes into the lunch hour consolidation. Let's go into a little bit of the markups and things I was calling live today. I shared this chart on Twitter later in the day, obviously. But if you watch my tweets and you are able to go through them, maybe not real time do this because you want to be watching price, but later in the day or in the evening whenever you get home, whenever you have free time, go to the Twitter, pull up the individual tweets between the 8:30 and 11 o'clock time window. It may be a flurry of tweets, and I don't appreciate anybody complaining to me that sending too many tweets, because that's the whole point of being on Twitter with me in the morning session. So between 8:30 in the morning up till around 11 o'clock or so, you're going to get blitzed with tweets if your alerts are on. Okay, so if you don't want to be constantly bombarded with real-time alerts about where I'm seeing price and where it's likely to go to next, just don't turn your notifications on. But don't complain if you miss something that would have otherwise been prompted by a tweet. So it's not a signal service. I'm not telling you to buy or sell, but I'm absolutely taking your attention to a very specific segment of price action, very specific candle with a specific price level that I'm reaching for. And you can take a look at what we have here. I was saying note the 4,035 ES sell side. That's this level right here. Below there, sell side on this candle right there. The next candle is here, and I'm saying note the 1038 1 minute candle fair value gap. That's this candle here, right there. I'd like to see it remain unfilled and reach under the 956 low. That's this low right here, the 956 low. And I sent that tweet right here. These are all individual 1 minute candles, so that way you can match up the time here and here. All right, and then the next tweet is right here as the market runs up into the fair value gap, that shaded area, right there on that 1 minute candle. See the date here? You can see these tweets still on Twitter. I would want to see it reject that fair value gap immediately, or it is no good. Now, I don't have the tweet here, but you'll find it in the same vicinity in terms of time. I mentioned that I don't want to see it trade to 4,051 and a quarter. That's this level right here. Why did I even make a mention of that? Because it's hypothetically where our stop loss would be, but you're not taking a trade. You're tape reading with me. Why there? Because this candle here is the high of the fair value gap. So your stop would be above that, and that's where it would be. Did it go there? No. Did it even fill in the fair value gap entirely? No. Why? Because that's exactly what I wanted to see it do. Leave it unfilled. It went in? Yes. Did it leave it partially unfilled? Yes. That's exactly what I tweeted at 10:43 in the morning. That's exactly what your chart shows for the E-mini S&P today. And the market tanks aggressively, runs into our objective, and this is me being my facetious self. It's just for entertainment value, folks. I'm not trying to be arrogant. I just want to make you feel engaged. It may not have that effect on some of you, and it's okay. I'm not going to impress all of you, right? So this candle here, I said you should be flat for those who are gambling. That is basically reminding you that you should not be taking trades, but I know some of you are just not going to listen, and you made money here and you banked. And then we consolidated below the opening price of the opening at midnight New York local time. That's this price right in here. I don't have that level on it now, but that's what we're seeing here. And it's below sell side, which is that low here. So what we're doing is we're looking at times when the market's likely to go one direction. How do I know what direction, Michael? I'm prompting you with a tweet like this. That is not a signal. That is me telling you where we are at the time when I send that tweet is going to determine what this tweet means. So the tweet was sent here. So if it's here and I'm tweeting about a level here, that means I'm expecting price to go where? Below that low. Below that specific level. Sell side below the quoted price level. So it would be 40.34 3/4 or 40.32. That's what you're learning to trust in your own observance of price action and reading the tape with us as a community. If I quote a buy side liquidity and it's above the marketplace at the time of my tweet, then I'm suggesting to you my focus is primarily looking higher. And then I'll usually send a tweet and I'll say, there's a specific candle like I do here, 1038 candle, which is this candle right here that creates the fair value gap. This candle's high, that candle's low. If you've been with me, if you haven't been with me long, by doing this very thing right here and looking at the reviews and the ideas that I share on my Twitter, you go into your charts. This is the work. This is the part that everybody doesn't want to do because they're either lazy or they just want to be spoon-fed. I'm not going to spoon-feed you better than this. There's nobody out here doing this. There's nobody going to take your attention to a specific level with a specific process of knowing what to do with that information and still not be a signal service. This is how you read the tape. This is how you understand how to read price action. And then you'll learn to trust your own analysis once you get better at it. But right now, you're learning how to use my concepts. But you have to trust that they work, right? So there's no better way of doing it than me taking you into a live market condition, pointing to where the market is right now, where I believe it's going to go to next, and what level is a catalyst for a turn in that direction. Okay? It may not be a fair value gap like I've annotated here on this very candle. It may be a bullish order block. It may be a breaker. It may be something else that I've taught on this YouTube channel. But I'll make reference to what it is. And it's not imperative that you understand exactly what that is at the time. Just understand that we're looking for the price to go above or below market price. And the key words are buy side liquidity. If I tell you to note that, that means I'm looking higher. If I say sell side, that means I'm looking for it to go lower. And then you're just looking at a level or a specific time candle. That's right here. See it? 09:56 low. That's this low right there. So I don't need to send you charts. In fact, I don't have time to do that. I'm already using a 1-minute chart. I'm doing the analysis and everything. And then I have to type out something. I don't have the time to dress a chart. And I don't like having my charts have all this stuff on it. So I don't trade with things on my chart. But I annotate them and put these things on there so that way you can see conceptually what it is that my concepts are building on with the lectures and things that's on my videos. So at the very moment it hits this right here, I said it needs to reject that and then sell off and attack the sell side liquidity. If it goes to this level here, which was also a separate tweet, 4051 1/4, or basically 4051.25, and that's what that is. And that would represent a hypothetical stop loss. So if it would have went up and hit that, then that would have been a bad trade transaction, and you would have seen me get it wrong today. And if there would have been a trade taken, you would suffer a loss, and or I would take a financial loss if it was a trade pressed. Okay, so you're seeing the logic of where the entry pattern would look like, where the stop loss would be, where's the threshold for pain to put you to, I got to get out. That means a stop loss would be utilized, and the stop loss should be utilized if you ever take a trade, whether in demo or if you ever decide to do this on your own and do it with live funds or trade with a funded account. You need to be using stop loss, because if you don't, you have risk of ruin that is absolutely possible, and with no experience and getting caught up in a loser cycle, which is typical of a new trader, you very easily blow your account. So I reaffirm everything here that that's exactly what we're looking for, and the screenshot it because this movement here from here is 5 handles alone. So that's enough to show you what 5 handles would look like, and you haven't even got down to this old low here or run out that low. And then it accelerates as we would expect to see. And then this tweet here obviously is saying that you got to be out of the marketplace. I already said that. So I think if you're looking for something to kind of like prove that there's a way to be able to time the market, look for setups, but also have the ability to grow independently, but part of the community here. You'll be able to see your own development each day, each week, every month that we go through this year. These things are going to be much more meaningful to you. And you're going to find that you'll start seeing them without ICT pointing to them. And that's an exciting feeling. It feels empowering when it happens. All of my students have the same reaction. It feels amazing. And they love it when I'm calling out something and they have it already on their charts. You can see their excitement because they're tweeting and saying, I got this already tweeted in my chart. And I'll say, oh, see, I already tweeted it. Look, it was over here. I did this in my so-and-so. And to me, it's awesome as a mentor because it means that it's transferable knowledge, which is exactly what I said it was, but it's not transferable knowledge to lazy individuals that are just simply watching my videos, because that's not it, folks. You have to do these things here, study it, and you have no excuse this year because I'm actually taking you into a chart live. All right, so in the afternoon, we had our typical afternoon 1 hour session before the close of regular hours at 4:15, but at 4 o'clock, we're looking for a particular run into that level. What level would that be? Well, I mentioned last night that I liked the 4,072 and 3/4 level. I reminded everybody this morning that we were looking up. That was where my charts were taking your mindset there. And in the last hour of trading between 1500 to 1600, and that equates to, in local New York time, 3 p.m. to 4 p.m. What I looked for was this low here to be tagged, which is what we saw here. I went in with 10 contracts filled at 63.25, which was the low here. So I got the low, and then I waited for this fair value gap. Once we traded into that with a down close candle, I went in with 10 more, rallied up. I missed the opportunity to go long 5 more here because I was going to do a 25 lot and I wasn't able to do it. So I missed it here, rallied. When it hit this order block right there, that was also a time when I could have entered another 5 contracts. I didn't take it there either, and I just watched it run up. And I realized that I might as well just show it to you and record it on my phone. Don't trade on your phone, folks. I'm only showing you when and how I can, because if I'm out and about with my wife, or if I'm doing some things, but also see something on my chart, or if I send an alert that has my attention drawn to a certain level, I know what I'm looking for, and I'll teach you how to do alerts and set your charts up so that way you don't necessarily need ICT after this year, because that's the part of this whole endeavor this year, to make you independent. You won't need me. You won't need to do anything with anybody else. It's going to be 100% you, and you'll be able to trust what you're looking for. It doesn't mean you're going to be perfect. Doesn't mean you're going to be a high strike rate with accuracy. It just means that you're going to know what you're looking for, and you're going to continuously do that and get better. But the market trades to that 40.72 and 3/4 level here. I start peeling off the 20 contracts. I got off at 5 with 40.72 and 3/4 on this one, 40.72 and 3/4 on that one. So 10 contracts of the 20 came off exactly at that level. And then at 40.73 even, I peeled off 5, and then I got stopped out on the balance. If you look at the recording I shared on Twitter, it's a small little video. I actually had my limit order to get out at 40.76, and the reason why I picked that level is if you look at this low and you take your Fibonacci and extend it to this here, the projection on that level takes you up to 40.76.25. And I'll let you have that for homework, that way you can see that. But I want to get out early. I'll sacrifice the actual best exits, because my weakest point as a trader, okay, my weakest link is my exits. And it's not because I can't see profitable exits. I demand, which is unrealistic, and I shouldn't be saying this to you because some of you are going to think that that's what you should be doing too. But the thing that plagues me as a trader, it's not entries. I have lots of entry techniques. I want to have the best exit. And the only way I satisfy that desire that makes up me as a human being, I believe perfection is going to be reached, subconsciously. I know reality-wise I'm not going to obtain perfection. But my subconscious is constantly trying to manifest that in my exits. So over the years, I've learned to learn where I think the market's going to go as a best case scenario. Then I'm going to try to get 80-85% of that price run. And I also will partial out in the vicinity of where I think that 85 to 90, maybe even 100% run will be. And that's exactly what you see me doing in my exits all the time. You see multiple scaling out because that is what I wrestle with as a trader. And I don't believe I'm ever really going to conquer it. And to be frank with you, I really don't need to. Because what I do is, in the opinion of other people watching and other even seasoned traders, the opinion is that I have very good precision and my placements and grouping for my exit and entries are phenomenal, which is wonderful. And I can appreciate their observations. And that's wonderful as a trader and as a man, that strokes my ego. But as a technician, the man, Michael, my obsessive compulsive disorder says that it's not good enough. So therefore, I have to continuously strive to be better at that. So to help compensate for that internal wrestling match, I've developed a methodology of just simply accepting partials in an area that is very close to where I think the best case exit would be. And sometimes I get very, very close to the high. Sometimes I'm maybe 10 handles, 15 handles away from the high. I'm trading and exiting that trade in the direction of my profitable direction. In other words, I'm getting out while the market's moving away from my entry. That's how I'm viewing it. So I'm not sure if that is helpful to any of you. Maybe your weaknesses are entries. Mine aren't. In the beginning it was. I had to desensitize myself, which is about the process of going in, is pressing a button and not worrying about the outcome. And you'll probably see me do that with my son. I'm kind of work with him with a $50,000 hypothetical account. So my TradingView account will be basically working with him. So it's not a matter of me showing you precision, because I'm going to be doing things with him, and you'll probably hear me talking about it, and he'll be probably next to me in the live sessions where I'm saying, this is what I'm doing here, and watch what I'm doing here. So that way you're benefiting from a lesson that I'm actually giving to my son, but it's to help him desensitize himself to entries, because he's fearful that he's not going to be as precise as he feels he should be, which is unrealistic. In the beginning, you're not. Okay, so I hold on to that level of expectation of myself on my exits, but you have to be able to get into the trades. Exiting is easy. You can come out with a static, get 5 handles, and once you get it, you get out. That's why I'm teaching you 5 handles. I'm not saying 5 handles is all you're going to ever become good at, but it's a target that's realistic and easy to aim for. There's lots of opportunities for 5 handles in price fluctuations intraday. But over time, you're going to graduate to understanding that, oh, I can see that 5 handle trade, but it looks like it's a better 12 handle trade or a 15 handle trade or 20 and maybe 30 and upwards. But you won't be able to see that until you can find very easy 5 handle setups. 20 tick trades are numerous through the course of an entire trading week, but you only need to have one of them. One of them. And with the right money management behind it, it replaces the necessity for a job. It's not guaranteeing you're going to replace your job. It just means it presents the opportunity for those that are skillful and have impeccable money management skills. You have the ability, the possibility, the potential to be able to replace a portion, if not all, of your employment income, which is, in my opinion, what everyone is really trying to do. You might want to be rich, and I'm not promising you're going to be rich. What I'm promising is you're going to be able to reprice better than you've ever learned before and learn how to do it more precisely from anybody else. That's the only thing I can promise you. But that doesn't equate to pushing a button in a live account and in profiting consistently, because you can lose sight of what it is you're trying to do with one loss, and it doesn't have to be a very big loss. It just means that your personality latches onto that as a personal failure, and you want to erase it. You want to fix it. And that's going to be part of the things you're going to learn this year. I'm going to tell you to go into your demo account and do certain things right there live. I'm going to say, do this right now. And you may look at this and say, this is exactly what I should not be doing. Why is he asking me? Because I want you to have drawdown to train yourself to dig yourself out of it. You have to do those skills. You have to learn how to do it. And you have to understand the process of doing it. And if you don't have that skill set, you will ruin yourself once you start trading with real money. Because you're going to panic and think you have to get it back right away. You don't. So hopefully this one tonight was insightful for you at least. And if not, there's next week. I'm going to be away from Twitter tomorrow, and I will touch base with you probably Saturday on a Twitter Space podcast, I guess. Shotgun Saturday, where I get in there and just jawbone about whatever is on my mind. Other than that, enjoy your weekend and be safe.